All right, so webinar started. It's being recorded. Oh, there we go. And people are coming in the door. Cool. So we'll get a couple, we'll let everybody kind of get in here, get their sandwiches squared away. I would show off my sandwich, but I'm having camera issues today, which did not come up in our test preview. So for you guys that are joining us now, we always have a quick little technology preview the day before. And for some reason, my camera is not working. So you guys are going to get my little profile picture that's on my business card. So as you guys are coming in, I wanted to thank Tony ahead of time for helping us get all this coordinated. None of this happens without her. She somehow I let her go on vacation last week for a week, and boy, did I miss her. So I wanted to put that out there or first, that I wanted to thank Tony for that. In the meantime, we wanted to introduce Paul Seekers. Did I do that right, Paul?
Seacrest, but yeah, close enough.
Seacrest. All right. Oh, like Ryan Seacrest, just spelled differently, right?
Yep.
There you go. All right, so we wanted to introduce Paul. Paul is with our marketing special products division, which basically covers non-QM. I was going to ask Paul before we got started if they're ever ready to go call it non-agency, but basically today, and I will ask that question, we'll start off with that, but non-QM, everybody stands for non-qualified mortgage. And what that means to you guys is it's things that do not qualify for Fannie Mae, Freddie Mac, FHA, VA. Now, all those loans are bought by agencies such as Fannie Mae, Freddie Mac, or Ginnie Mae. So recently, as of last year, there was a move within the industry to change non-QM over to non-agency. So, apparently it's going to be one of those two things. So if you guys ever hear, you realtors that are here with us today, ever hear the word non-QM or non-agency, it's pretty much the same thing. These are loans that fall outside of Fannie Mae, Freddie Mac, FHA, VA. We're lucky enough to have Paul here. Paul sat on my side of the desk for about 8 years before joining CrossCountry in 2019. And Paul's going to basically walk us through products that you guys need to be aware of, so that if you have a buyer, a lot of your buyers have their own lenders, and they may go to a lender and say, well, the lender says I don't qualify because of this. Well, if you hear something like that, we're going to be able to give you the types of products or information on products where you go, you know what, you want to talk to my lender because my lender has access to this, and that might be a product that would still allow you to get into a home. Before I introduce Paul, which I've pretty much done, I just wanted to let you guys know you're going to interact with us via the chat. We're going to encourage you guys to ask questions. We really appreciate that because we know you're listening. And also it helps because sometimes the question you ask is really being thought of by a couple other people that are in the audience with us today. So with that being said, Paul, I turn it over to you to talk to us about non-qualified mortgage / non-agency, and what the agents are going to know is loans we need when the clients get turned down.
Absolutely. Thanks, Rich. And that is a perfect way to think about it. Essentially, when you kind of hear these really industry specific terms, non-QM, non-agency, essentially what you want to think of when you think of these loans is anything outside of your standard conventional Fannie Mae, Freddie Mac, or your government loans, FHA, VA, USDA. They're called a lot of things. Really what the kind of the goal of these products is to help more borrowers get into homes. So if you kind of think about these products with that in mind, that's a kind of a good jump off point to start. So go ahead and go to the next slide. So now non-QM, basically, so this was something that was around a little bit before the pandemic. And once the pandemic hit, these were the first loans to go because these are the more difficult ones to get done in terms of they're not signed off by Fannie Mae or Freddie Mac. CCM has multiple in-house non-QM loans, meaning We do them in-house with our incredible underwriting turn times. Our loan officers drive the show, and you are able to kind of have that line of communication between CCM, whereas most companies are going to be sending these out to shops that specialize in them, which can take longer, more headaches for your borrower, delayed closings, etc. Now, CCM has two specific proprietary non-QM product lines. We have Signature Expanded and we have the Signature Select. Underneath them, there are different types of products, which is what I'm going to be getting into today. But when you think about loans that are outside of agency to help your buyers out, Signature Expanded, Signature Select, CCM's gotcha. One other thing I wanted to note that a lot of companies aren't doing. So I don't know if you're familiar with CCM's fast track pre-approval process. Basically, it's a pre-underwritten pre-approval to ensure that your borrower is well qualified, but also that there's going to be less hiccups in the process. And these non-QM loans are available to have that pre-underwritten pre-approval so that you can make it so that it's even quicker and smoother of a process when helping your borrowers get into these new houses.
Yeah, that's a big deal. Actually, I want to talk about that for a second, because up until last week, we were only offering the full underwrite on our agency products. Now, if you guys have a bank statement loan, an investor cash flow loan, any of these kind of programs we're going to cover today, we can bring this product back to you guys fully underwritten, subject to typically title and appraisal, and we can close in 14 days or less. So pretty aggressive stuff. We know it's still pretty competitive out there, in spite of the fact we might be competing with 5 or 6 offers versus 24 offers, but we are still competing. So that fast track makes a big deal of a difference.
Perfect. So then the next thing I'm planning on, I want to talk about with you guys is kind of the, for lack of a better word, the crown jewel of non-QM. And kind of the goal of today's call is I'm going to kind of go over the basic products of non-QM, who they're for, and kind of how they're used within the market space. So the first one is going to be the bank statement program. The biggest thing with this program is it's for self-employed borrowers. So the beauty of being self-employed is you get to write off a lot on your taxes. Unfortunately, the other side of that coin of being able to write a lot of things off on your taxes is that Fannie Mae and Freddie Mac, when they're requiring us to underwrite a self-employed borrower's income, they make us look at the bottom line of the customer's tax return. So after all of those deductions, so somebody who truly brings in $100K a year after deductions might only show that they bring in $40K a year. Well, that's going to significantly kind of deter their buying power, but then also it might kind of preclude them from buying a home at all because their income's so low. So one of the things with this program that's really nice is instead of looking at the borrower's tax returns, it tries to kind of develop the income in such a way that it gives a little bit more kind of realism to the situation. So instead of looking at the tax returns, it's going to look at the borrower's bank statements. It's going to tally up all of the borrower's business deposits over either 12 or 24 months, and then essentially craft their income from the actual money coming into the business. In a nutshell, that's what it is. And some of the kind of quick highlights to this program. On purchases, all you need is 10% down. You have the ability for some lower FICO borrowers. We can go down to 600. We can go into the jumbo loan amount space of up to 4 million. There's ARMs and there's fixed rates available depending on the borrower situation and what may be best for them. And then lastly, with DTI, you can go up to 55%. So the big thing with the DTI going up to 55% and the ability to look at the bank statement income as opposed to the tax return income, what you're really doing there is you're increasing that borrower's buying power, meaning they can afford more house, purchase more house, and then for us as loan officers, bigger commission. For you guys, bigger commission, that sort of thing.
Yeah, and I want to add a couple things, and certainly we'll open the door for questions. You guys, any questions you have, put them in the chat as it relates to this subject or anything else we cover for that matter. But really the big thing, this program's coming to play a little bit more. We're coming out of the pandemic, which is dynamite. We're back to the real world, albeit now we have higher rates and inflation, but at least we're coming out of a situation where a lot of businesses were forced to close, and this situation impacted it pretty negatively. With Fannie Mae, FHA for sure, Freddie Mac, Fannie and Freddie on occasion will require us to do a 2-year average. Well, 21 might have been better for somebody, but 20 was a mess because of the pandemic. If I'm forced to do a 2-year average, and over the pandemic years that we've had in the last 2 years, income was stressed in one of those 2 years, well, a 2-year average isn't necessarily going to give the best picture nor the most buying power for some of your borrowers. In this situation, we say, hey, you know what? You had a lot of losses, you had a lot of write-offs, and very important to know, Fannie Mae, Freddie Mac, FHA, they do not allow us to take any PPP money, any government stimulus that went into this business, which a lot of these businesses lived off of. Those things were excluded from income when we were looking at looking at full tax returns. So that was a big deal. Bank statements became a lot more popular because we can see cash flow versus expenses, and that was a much easier way to get people qualified. I don't know if you wanted to speak on that, Paul, as far as leveraging bank statements because of the pandemic, and then I'm going to read a question coming out from the audience to you.
Yes, no, and spot on with that. And that's really the big piece of, you're right, the PPP loans, but then also, and this is something that even before the pandemic was something that kind of could sometimes screw over self-employed borrowers, where especially when you're in those first couple of years of getting the business going, where your business is kind of exponentially growing every year. But if Fannie Mae is going to require you to look at the last 2 years, maybe last year your business made 200,000, but the year before it was still getting going and only made 50. Well, Fannie Mae very well may make you average those together, whereas a program like this is going to let you capture the true kind of growth of the business and only require you use that 200K instead of averaging the two together, obviously bringing the income down.
Yeah, no, it's a great product for that. And again, as little as 10% down. Now, Alexandria Pope has a great question. Thank you, Alexandria. Is down payment assistance allowed for this program, Paul?
So gift funds are allowed, but true down payment assistance from like a housing finance agency or like Illinois Housing or something like that is not permitted.
Yeah, correct. Yeah. So, yeah, and then again, IDA does control the back end loans that we create. So when we're doing a government loan or a conventional loan, that's actually all running through IDA's program as well. Chinoa doesn't play around with these types of programs either. So, so relative to Alexandria followed it up and said from the seller.
From the seller,
yeah,
you absolutely are allowed to do seller concessions with these. For the most part, they pretty much follow agency guidelines. So if you're doing an investment property, 3%, but the max on a primary residence is going to be, depending on the LTV, is going to be 9%, anywhere from 6 to 9%. So you absolutely can do seller concessions on these.
Cool. And then to follow up, seller's concessions is for all closing costs, not for down payments, but you can use those. You can pretty aggressively get into seller's concessions, maybe as high as 9% owner occupied or 3% non-owner occupied. So great question. Thanks, Alexandria. Any other questions on bank statements and self-employed? And we're going to cover some other products in here that also assist with self-employed. And Paul, I'll let you take us to the next slide.
Absolutely. One last note on bank statement program. When I normally are training new loan officers on this and kind of talking through this with them, I consider this program, the bank statement program, to be like the George Washington of the Mount Rushmore of non-QM products. Like if you're only going to kind of keep a couple in your back pocket, this is probably the first one you want to keep in your back pocket.
Nice, nice.
All right, so then the next program is going to be the asset qualifier program. Kind of shifting gears a little bit away from the bank statement program. This program is specifically designed for folks who have high net worth, specifically folks who have a lot of assets that they want to use to qualify off of the mortgage. So where this is a real big pickup from like your normal Fannie Mae and Freddie Mac loans is they'll allow you to use assets if you have them, but you generally have to make a distribution. And a lot of times you have to be at or above retirement age. So for the person who, is a crypto millionaire or inherited a bunch of money or something like that, who has these assets, traditional programs don't have mortgages for them. Even though these are good borrowers, they have plenty, they could pay, most of them could pay the loan in full, but for whatever reason want to remain liquid and still get a mortgage. So the way to think about this asset qualifier program is instead of qualifying your borrower based off of their W-2 or Social Security income or tax returns, you're exclusively looking at the borrower's assets that they have in the bank. And by assets, I mean checking savings, money in stocks and bonds, life insurance policies, things like that, to solely qualify them based off of the loan. And
so Paul, I want to,
go ahead.
Yeah, no problem, buddy. I just, and I apologize. I thought it was a good break point there. So one of the most common people or client scenarios that I get for this type of program is somebody they got an incredible offer on their business. They built the thing up, they were ready to sell it, they sold the business, and now they want to actually go capitalize on this newfound wealth and go buy a piece of property. But they're also planning maybe to take a couple years off, or maybe they even were under contract to take a couple years off before they could maybe get back into that industry. So there's zero income stream coming in, but yet they've got this fat bank account, and you go try to qualify for a mortgage and everybody goes, you really don't have a job. What happened to that? So, this is the perfect program for somebody in that. Those are the ones that I actually see more often than anything else on my end, number one. Number two, and I don't know, is that the most common scenario for you, Paul, or do you see something else?
So what I see a lot of is the folks who are recently retired. Maybe they retired a little bit early and are holding on to their 401k or their IRA or waiting to pull out stocks for tax reasons. And they have all of this money, but maybe they just don't have the W-2 job they used to. And there's like kind of that gap of from being like a full-time into the workforce and being fully retired, where they haven't taken distributions and stuff, but have all of this money and maybe want to go buy another home for retirement, or looking to downgrade from their current home to their retirement home. And they just don't have that income to show right away. This is where I see that one a lot.
Okay, perfect. And then the other question that I had is, do they need to liquidate their crypto?
So our program only allows for Bitcoin at this time, and no, they do not need to liquidate it. What I will say is on this program, this might be getting a little bit in the weeds in terms of underwriting, but essentially what they'll do is if you don't liquidate the crypto and you keep it in there, they're going to apply a haircut to the crypto. If you pull the crypto out and put it into a bank account, then you can use the full amount.
Okay, perfect. All right, go right ahead, my friend.
No problem. Okay, so then another nice thing about this, and this is something that's this is a quirk of this program that is helpful, is for folks who are very wealthy but may have their fingers in a lot of different pots, in terms of maybe they own 5 businesses and 12 rental properties or something like that. And some of them, they're at different stages along the way, and some of them make money, some of them lose money, but nonetheless, it would just be a headache to document everything. And maybe that's where they've run into problems in the past trying to get qualified. Well, with this particular scenario, because this program doesn't require to look at actual employment income, this program's not really concerned about developing income or developing the employment documentation. So for a borrower who has a very complicated situation, this may be a route to go, because then all they need to do is show their assets, instead of having to show, hey, well, actually I own 33% of this business and 50% of this business and 100% of this business, which is going to require more documentation, more kind of hassle for the borrower. It ends up being a little bit smoother of a process. Another thing with this program, and this is a little bit kind of out in left field, especially if you know anything about mortgages, is this program does not have a debt to income ratio, because simply because there's no actual income being calculated. So that begs the question, well, Paul, how do I know my borrower actually qualifies? So the way that it works is essentially a pass-fail method. If the borrower has enough assets, they qualify for the loan. If they don't have enough assets, then they don't qualify for the loan. So there's no issues going to be in place of, well, my borrower has a $700 BMW payment and they don't qualify for this, so we got to wait for the borrower to refinance that or sell the car so they can qualify. That is not a thing in this. So it ends up being a lot smoother of a loan for these types of clients.
Nice.
Does anybody have any questions in regards to the asset qualifier program?
Wait, we got something. What's considered enough assets? For instance, if they were looking for, let's say they're looking for a $200,000 home, we'll assume 10% down because that's probably typical for that buyer. So 200,000, 10%. Great question, Denidra. What would we be looking at, Paul, for that?
So as a general rule of thumb, the easiest way, it gets a little bit more nuanced than that, but if you're looking for something kind of a bullet point to write down, if they have between 110 and 120% of the assets, 110 to 120% of the loan amount they are trying to take out after closing, they should be good to go.
Cool. There you go. So yeah, that's a great rule of thumb. So enough assets, $200,000 home. We'll give Denidra exactly what she's looking for, 10%. Plus we're gonna go 110% of that. So roughly about 198, 200,000 in the bank. So that should be enough to get them into that property. So with 10% down and they keep the money. That's a great question. What a great rule of thumb too. So awesome. All right, what do you got next for us?
Actually, one note I wanted to make on this one real quick, and I wasn't planning on talking about this, but for the sake of the argument. So the program that I'm talking about right now is where the borrower solely qualifies based off of their assets. I'm not going to talk about these programs today, but just for your own peace of mind, CrossCountry Mortgage also has programs where you can use the borrower's assets to supplement their W-2 income, to basically help them increase their purchasing power. Like maybe they just don't quite qualify for the dream home that they're looking for, but do have some money in the bank. We do have some programs that allow that as well. So if that situation ever arises with your borrower where your borrower is like, hey, I really want to buy a $500,000 house, but the bank's just telling me I can only afford $450,000 or something. If you haven't already reached out to us, reach out to CrossCountry because we may be able to help that borrower increase their purchase power.
Perfect.
All
Perfect.
Right. The next program, this one is also on the Mount Rushmore of non-QM programs. This one is very helpful. And to be honest with you, this is one of the more used ones because it's geared towards real estate investors. So basically what this program is, it's only for investment properties. And the idea behind it is real estate investors purchase a lot of properties. They get a lot of properties in their portfolio, but then what ends up happening is Fannie Mae and Freddie Mac will only allow you to own 10 total finance properties if you're buying or refinancing investment properties. So that means once they build their portfolio up to 10 properties, that means they have to either go get hard money or find another alternative to finance these properties. This program is one of those alternatives. So what this property does is it allows for more than 10 finance properties, but then more importantly, what it does is instead of calculating when a borrower is buying a property to be income generating, what the borrower is looking at is they're looking at, hey, what's my mortgage payment going to be on this property? And what am I going to be able to charge for rent? They're looking at it in a singular situation. most of the time they're not going to be looking at it. Well, how does this affect my W-2 income and my other rentals? So what this program does is it kind of hyper focuses the qualification. Instead of looking at the borrower's W-2 and the income that they're able to generate from other properties, it's strictly looking at this property's ability to generate income. And the way that they do that is through something called DSCR. What DSCR stands for is debt service coverage ratio. Now that's a little bit of a mortgage jargony kind of term, so no need to learn that term. Really, what you need to think of is when you think of these investor loans or investor cash flow program, is that it's throwing out the rest of the borrower's income and only looking at this specific property. And so you'll see here at the bottom, how does it work? It's basically rental income versus mortgage payment. So if the property can generate more income than the mortgage payment, chances are that that borrower can do this loan.
And you're talking about, guys, when we're talking about this particular program, if you're working with investors, and investors have, they're very, very aggressive with their write-offs on their income. And you've got some investors out there that this is their world. There is no W-2 job. They're literally making money from having rentals, flipping homes, and things of that nature. And maybe for whatever reason, they've been turned down by a bank because their tax returns are not that strong. This particular program, we do not look at their tax returns. We are basing, as Paul mentioned, the ability for them to buy this rental property is simply based on, does the rental income cover principal, interest, taxes, insurance, and association? So no DTI, no personal income. And this is such a powerful program for investors. Paul mentioned it being up there on the on Rushmore, and we've used this program many, many times when somebody came to us and said, hey, I want to get into investment property, and maybe my tax returns, maybe the business I'm running showed some losses. We got impacted by the pandemic. I was aggressive with my write-offs. Hey, I just quit my job because now I've got enough of an investment portfolio. I want to move forward. So there's a lot of different scenarios to use this, and it's a really, really, really strong program. So Mike has got a question. He said, do you need to have current investment properties in order to qualify? That's a great question. I'll let you take that.
No problem. So the answer to that, Mike, is yes and no. So generally, as a general rule of thumb, you need a 12-month landlord history to do this particular program. That being said, our program has I'm going to call it a caveat or an underwriting quirk that will allow you to waive the landlord history. There are some LTV haircuts, and the borrower does have to currently own their primary residence if that's the case. But yes and no. So normally you do, but we do have options where you can waive that landlord history.
There you go. So it can be done on an exception only basis, which is good. And the other point that Paul brought up, which I think is also really good, there are some of these programs out there in the marketplace where you can't do this unless you own your own primary residence. As Paul has alluded to, our program will allow you to do this if you don't own your own primary. Paul, you want to clarify that?
Yes, no, so it will. So if you have landlord history, you don't have to own your own primary residence. If you don't have landlord history, then they do require that you own your own primary residence. And simply the reason for that is because what this investor doesn't want to have happen is that you are basically lying and buying your primary residence with this program.
That's perfect.
And then it looks like then we got another question coming in. What if I have a client that currently owns their residence but wants to sell it and get an investment property? So hypothetically, you could do that. What I would say though, in that particular scenario, if I was the loan officer, I would probably be looking at doing a regular Fannie Mae loan with that person, simply because they won't have another housing payment at the time. For some reason that Fannie Mae loan didn't work, then yes, this could be an option for you.
Great question, Raven. Thank you very much.
One other thing I wanted to kind of note about this is when I was originating, this was probably my favorite product to do because I really liked working with real estate investors. One, real estate investors do more loans than the average person. Two, once you do that first loan with them, normally that's when you're building the rapport. That's when you're getting to know them. And then they're kind of like a friend and they know you after that. And it ends up making it a little bit easier. The last thing that I found a little bit easier with working with real estate investors in this program was generally because they're purchasing the property for income driven reasons, there's a little bit less emotion involved in terms of selecting the property and things like that. So they can sometimes they'll end up being a little bit easier of borrowers. Now, I will say kind of the downside is sometimes because they've closed a couple more loans, they think they know it all, which can be a different side of the coin. But I found real estate investors a lot easier to work with in these transactions to get done just simply because there was less emotion. It's more about the math with them. So for what it's worth.
And again, from our perspective now, guys, we are offering this program in the fast track, which is great. Good deal.
All right. I will, if there's no other questions, I'll move on to the next one.
Yeah, we're all set. Paul, go ahead.
Perfect. All right. So the next one is called the Full Doc program. This one doesn't have quite as fancy of a name as some of the other ones. And for lack of a better word, when you think of this one, what you want to think of is for a non-QM full doc product is you want to think of just miss agency. So something that's going to just fall out of agency guidelines for whatever reason, whether it be because the property is not eligible, whether it be because the borrower maybe has a kind of blemish on their credit of some shape or form. That's kind of what you want to think of this. And this program is actually better to talk about in terms of the kind of unique features that it allows, which is what I have right in the why does it exist. So the first one, recent credit event. So standard Fannie Mae and Freddie Mac is going to require 4 years for bankruptcy, 7 years for foreclosure. FHA is going to require 2 years for bankruptcy, 3 years for foreclosure. This program actually allows you to do a loan for a borrower who is 1 day out of foreclosure, 1 day out of bankruptcy. So maybe
that's crazy.
Maybe that person that was kind of in the pandemic and kind of lost a bunch and ended up good borrower, but for circumstances outside of their own had to file bankruptcy. Well, right now they might not be able to get a loan at all. Well, with our CCM signature expanded full doc product, we can help that borrower out today.
Let's talk. Hey, Paul, so we've listed 90% LTV on here. I'm going to guess a guy a day out of a foreclosure or bankruptcy is probably not hitting the 90%.
Correct. So the way that we have basically what we do is there's LTV haircuts depending on how close your bankruptcy or foreclosure was. So the way you want to think about it, 0 to 2 years. Max LTV is 70%, or the way you want to think about it, 30% down for your borrower. And 2 to 4 years is going to be 75% LTV or 25% down.
Perfect.
This next one is a pretty cool little feature here. It's called departing residence feature. And I've seen sometimes people will sort of advertise this as a product. What ours ends up being is more of a kind of an underwriting quirk. But so we've all had that scenario of I have a borrower who's looking to buy a new house, but he has to sell his current house because he doesn't qualify for the new with both payments. So generally what I would do when I was in, I don't know how you guys handle it, Rich, but I would normally have to coordinate a simultaneous closing, which sometimes can be easier said than done. So we have this underwriting feature essentially kind of helps circumvent that to make the process a little smoother. So what this departing resident feature says is you can exclude the borrower's current mortgage payment when calculating to see if they qualify for their new mortgage payment. And the borrower doesn't even have to be in contract or have the property listed. What this is going to do is this is going to help eliminate those simultaneous closings. But then also, especially in a market like this where a borrower may be afraid of having their house sold prior to buying the new house and being, essentially homeless for a couple of days, basically what this program can do and kind of help alleviate that. So what this thing does is essentially says, hey, if the borrower has some equity in their current property and they have a couple extra months of reserves, we won't even hit them for that payment. So that's kind of go ahead.
So really, so for anybody out there who has been struggling with a borrower whose, lenders come back and said, hey, got to sell the house. So if you're going to make this offer, you're going to make this offer with a sales contingency. And we know that that's pretty tough offer to get approved right now. This would be a perfect program to offer somebody to not have the sales contingency and still be able to move forward.
That's a great point. Next piece is going to be interest only. So essentially what interest only is, and I won't spend too much time on it because the name's pretty much self-explanatory, but interest only is for lack of a better word, like the way I think about it is kind of a payment feature on the loan. And so how interest only works is the loan term and the interest rate, those can all be fixed or an adjustable rate mortgage. That's not changing. But what does change is for the first 10 years of the loan, the borrower is only required to pay the interest portion and the taxes and insurance. So this is a good loan for maybe somebody who is, maybe like a medical professional who is kind of getting into their career and knows that they're going to be making, $200,000 more over the course of the next 5 years and wants a lower payment now. Or potentially even somebody who is using this as kind of a starter home and knows they're only going to be in this loan for 5 years and doesn't want to pay in as much as they potentially could.
Yeah, that interest only is really good. So Marie's got a question for us that'll go back to the departing residents, and we probably should have covered it, but it's a great question. So, so Marie says, hey, so they can't use the equity in the current home on the down payment for the new home in this full doc program. The answer is yes-ish. In other words, this program, you could use this program where they'll not look at any of the debt on the house. Now, what we can do is create some debt on that house. So CrossCountry does have a bridge loan program, which is internal, where we will actually help them take the equity out of their existing home to put into the new home. So, and Paul, your department administers that?
No, an adjacent department does, but you basically hit the nail on the head. Okay. That's exactly what it is. And that, so essentially, like, to answer your question, this departing residence feature does not allow them to tap into that current equity for down payment and stuff like that. But our bridge loan is the product that absolutely can do that for you.
And we can use the bridge loan in conjunction with the full doc program.
I believe so.
Okay, cool. So yeah, so we can get them in. So one last question about this, and I'm not sure you'd know this answer. Do you know, Paul, if the departing residence loan allows a recast at all?
Let me try to think who that investor is. No, they do. That investor does not allow for recast.
Okay. All right. Terrific. So we won't get into the recast unless anybody asks. Hint. All right. Go ahead. Keep explaining.
There you go. Perfect.
I'll explain recast if somebody asks. So.
All right. So then the next piece is going to be the non-warrantable condos. I would imagine, being from the Chicago area, you guys probably see these a little bit. This is probably our most popular use for the full doc program. And essentially what non-warrantable condo means is any condo that for some reason or another Fannie Mae or Freddie Mac don't like. It could be an excess amount of commercial space. It could be something like litigation. It could be something like a certain percentage of the residents in the condo association are behind on their dues. One entity owns too many of the units. There's a whole laundry list of items that basically Fannie Mae or Freddie Mac will say, nah, sorry, we don't want that. Well, when you do run into one of those situations, or if maybe you kind of know going into it, you have a buyer who says, hey, I really want to look at these condos, and maybe you've worked with that condo project before and it was a nightmare. think of CCM and think of this product, because it'll be a lot easier to get through.
Yeah,
And then
and to that end, I'd be curious if everybody wants to, anybody wants to type in the word yes, if you've actually had a condo or a loan turned down because of something wrong with the condo project, not necessarily something wrong with the borrower. Little feedback on there. I would imagine a lot of agents have had that situation, but we'll ask for a little poll on that. Go ahead, Paul.
all right. So, and then just kind of to piggyback off of that is honestly, like, not just this product, but kind of any quote unquote non-warrantable condo that you run into. Think of CCM. We have other outlets out there that are like, don't even really look into the condos. All they literally say is, hey, is it a condo? Did the appraisal pass? Okay, we're good. So even if for some reason it doesn't meet the qualifications of our full doc product, we have a slew of other options as well. So when you think a non-warrantable condo or a tough condo, think of CCM.
That's great.
All right, next piece is going to be condo tells. Generally, condo tells are very area specific, and normally they're more, normally they're more like resort areas and stuff. But when you think of a condo tell, basically what you want to think of is it's going to be like a condo, but maybe it doesn't have a full kitchen, or maybe it's got a concierge service. You see these a lot in Florida, and then kind of in like the Colorado, Utah areas. But essentially, I don't run into it very often in the Midwest, but if you do ever run into one that is a condo tell, which kind of falls under non-warrantable condo as well, think of CCM.
Yeah, we've got those up towards Lake Geneva. They've got some condo hotels, and they've got some projects actually down by Starved Rock that actually are condo hotels as well. So,
okay, I'm from Cleveland, so we don't have a ton of those. We don't have a ton of tourism coming this way, but
come on, Hard Rock.
yeah,
so
right.
Rock and Roll Hall of Fame. So there you go.
All right, and then the last one that I want is that asset utilization. That's what I was telling you guys about before during the asset qualifier, is where, so asset qualifier, that's the borrower is going to solely, exclusively qualify off of their assets. Asset utilization is more about, hey, my borrower needs a little bit extra boost to get the house that they really want. Do they have assets? Yes. Well, then we can use them to supplement their W-2 income or their self-employment.
Yeah, that's just such a big deal if they're falling short from what you guys can qualify them for. So what you want to hear or listen for as a realtor is if they're falling short in qualifying, like the loan officer, or the bank, or the credit union, wherever, they're coming back and just saying, hey, you're tapped out at 300,000, and you're scratching your head because the client came to you and said, hey, look, I have $500,000 in my retirement account. What do I do? And I believe we could use those assets to supplement that and maybe take a $300,000 approval and get them to 400,000 so that they can get into the price range that gets them all the things they want, the bedroom counts, the rooms, the school district and everything. So this is another great product for that.
Exactly. Exactly. And remember, 10% down for purchases, FICO's down to 600, and then we do go into the jumbo loan space up to 4 million.
Got it. So we did have, Denidra talked about a client that they were talking about, a hard money lender. So typically when we talk about hard money, we're talking about fix and flips, and that's really not a space that we spend a lot of time in here across country. So, but if it was hard money for some other reason, Denidra, that could be something we'd want to look at under our signature series, but fix and flip is just not one of those things that we cover under this product line. So
yeah, but depending on what that borrower was actually planning on doing with that condo, we may be able to help them. If they were just looking to purchase it or pull cash out or something, we could probably help them.
Okay, cool. Good to know.
All right. On to the next one. So the next one we have, okay, yes, she's saying he wasn't doing a fix and flip. Yeah.
Denidra, so, we need to talk about that one for sure.
Reach out to Rich on that one. All right. So the next one is going to be foreign national. Foreign national is kind of easy to think about. It's not the most popular program, but it definitely does serve its purpose. And basically the way you want to think about foreign national is going to be borrowers who do not live in the United States, who are looking to purchase an investment property or vacation home in the United States. And the reason why that can become a big problem is, and why this program exists, is because there's a lot of trickiness when it comes to calculating foreign income. You're talking translators, you're talking currency converters, things like that. The big piece, though, that a lot of people don't have if you're living overseas, and why would you, is don't have US credit or a social security number. So if you don't have those things, chances are you can't get a loan with the agency. So what this program does is tries to accommodate for that. These borrowers are generally good borrowers. They're normally well established in the countries that they live in, and they're looking to either buy property as an investment or buy a vacation home here. One of the cool things at this program, it's a little bit of a misnomer in terms of the name of our program, but this program can also help US citizens who are living abroad that have lived abroad so long that they no longer have US credit. Like maybe they closed all their credit cards, they've been living abroad for 10 years. Maybe, their parents are getting older or something and want to move back, or at least have a residence back home. This program can help them as well.
Excellent. Don't have any questions about that. Let's move on to the next one, Paul.
Perfect. So the next one, this one is another one. This is another one you want to think of for self-employed borrowers. The 1099 program is very similar to the bank statement program. And hypothetically, if you have somebody who's self-employed who receives 1099s, they could absolutely do the bank statement program. But what I would actually suggest is, hey, you may actually want to look into the 1099 program, simply because if I was a borrower, I would much rather be giving you 2 years or 1 or 2 years worth of 1099s than 12 or 24 months worth of bank statements. Basically, what you want to think of this is, instead of using the borrower's bank statements to qualify, what they're going to do is they're going to look at the borrower's actual 1099s that they were issued. And it can be one 1099 that was issued from a company, or if you're more of a, have month-long projects and you have multiple 1099s, you can tally those up over the course of the year and use those as well. And again, the whole idea behind this is, the beauty of being self-employed is you can write a lot of things off. Well, that doesn't always take in the full picture, but Fannie Mae and Freddie Mac will want you to look at the bottom line, not the true picture. What were you going to say, Rich?
Yeah, I'll get to my question in a second. Paul's got a great question. He says, so he did, well, I don't know if it's a question as much. We were responding to that association issue, but he mentioned a loan lost due to high percentage of non-paying owners who were late on their assessments, and lawsuit against the association. So, that's kind of a double whammy, but, I don't know if you want to speak to either one of those things. And then I've got one for Marie just brought in a 1099, and I've got a really good 1099 question for you as well. Let's go back to the association piece though.
Yep. So with those, hypothetically, you can do both of those. What generally in the condo world, what they're going to be looking at is residents who are delinquent on their HOA dues greater than or equal to 60 days. Normally, the kind of the base percentage is 15%. That's like what agency will allow, and we do have options available for less than that.
That's good.
And then the other piece, the lawsuit.
Was a lawsuits, yeah.
So the lawsuit litigation, that's going to be more case by case specific. It really depends on what it is. A lot of times what kind of we see is it's very minor litigation, but obviously, like if it was a lawsuit against the structure that collapsed in Florida, that's going to be a no-go pretty much.
Yeah, something pretty dramatic as far as size and scope. Fannie and Freddie will see that lawsuit and they'll just turn around and run for the hills. Where we're going to go into the lawsuit and go, hey, this was some board member that got called a name and now they're suing for $20,000 over defamation. And you look at the reserves and you go, this isn't a big deal. If they lost this suit, they can pay the $20,000. Let's go ahead and move on. And a lot of stuff is very minor, might be a slip and fall for 15, 20,000 or something like that. Those things are going to spook Fannie and Freddie. Whereas we're going to be like, hey, we're going to be good with that type of thing. So Marie had a question on the 1099 program. Is there a minimum amount that they can make under the 1099? And I think I'd be looking, I think, just from a perspective answer, the amount, well, I'll let you go ahead and answer that because I got an idea, but I'll let you answer it.
So technically there's no minimum, but the borrower would still have to qualify for the loan.
Exactly.
So you couldn't have a 20,000, you couldn't have a 1099 that averages $1,000 a month and expect to qualify for a $4,000 mortgage payment.
There you go. So, and what else these 1099 programs I think are good for. And Paul, I wanted to ask you this question. So, occasionally I'll get that application from somebody working in the movie industry. Or if they're working in the movie industry, and certainly the issue there is when the movie's running, they're getting paid. When there's no movie, they're not getting paid. So if we put somebody who's a contract person who's running something along those lines, do they verify that they're currently on set somewhere? Or are we literally just taking last year's 1099s and in the years before and averaging them out? What are we doing to verify today's employment, I guess?
So they're not looking at that. What they may want to do is look at year to date to see if they have anything. But in that particular scenario, and this is actually a kind of a really good jump off question, is another way to think of these non-QM loans is they're not as black and white as like Fannie Mae and Freddie Mac are. These are like picture loans, if you will, like kind of paint a picture. So in the case of that Rich just brought up, I would say if the borrower wasn't on set right now generating income, you would want to have the borrower write an LOX kind of stating, hey, I've been in the movie industry for X number of years. These are the projects I've worked on. You can see my W-2s getting paid. This is a regular thing for me. And then kind of develop that as that is their business and that they will be getting future work. Kind of.
Right. And a lot of independent contractors are picking up 1099s. We've got certainly a society now that leans more towards contracting itself out for employment, where we're going to see a lot more need for this. But again, when they get to their tax man, the tax man's like, oh, you had write-offs and this, that, and the other thing, where those clients may be better served in this type of program.
And when you're talking to your buyers about this, they might not know the difference. Like they might be, oh, I got denied because I was self-employed, or they're having trouble verifying my income because it's self-employed. Whether we help them with the bank statement program or the 1099, we got your back and we can help you. It's one of those things, and we'll be able to kind of determine, like, if really what it is if you think of, hey, I have a self-employed borrower that maybe can't get qualified or is having troubles or is discouraged because of where they're going, think of CCM, and then we'll be able to help them determine, hey, you know what, actually, I don't need 12 or 24 months worth of your bank statements. Just send me your last year 1099s, and then we'll be able to kind of help them with that.
That's perfect. Perfect.
All right. Does anybody have any other questions on 1099?
On to the next program.
Perfect. All right. So the last one we have here is going to be ITIN. This is becoming more and more popular. Basically what ITIN is, it's the tax identification number. And this program, and slightly different from foreign national. So this is generally for borrowers who do not have social security numbers, just like foreign national, but these borrowers are living and working in the United States, and they're generally looking to purchase a primary residence in the United States. So technically you can do ITIN loans with Fannie and Freddie, but they make a ton of hoops for you to jump through. Basically, they want a ton of documentation in regards to the borrower's work history, their visa requirements, and their continuance of their visa requirements. That last part, the continuance piece, is where a lot of folks will end up getting tripped up. They say, hey, well, I got my work visa for the next 2 years. And Fannie Mae may ask, well, yeah, but what about after that? And you can't just go to the government and say, hey, am I allowed to stay here for 2 more years so I can buy a house? They don't care. So with this one, what this one's for is to try to kind of, this exists specifically for the folks that fall out and can't do Fannie Mae and Freddie Mac. And the big piece and key to this is there's less stringent visa documentation. Generally, what they're going to do is they're going to look, hey, are they making money? and do they have a work history, and do they have an ITIN, they're not going to get bogged down in the specifics of, okay, well, what does their work visa say? When does it expire? Does it meet those rules? That's kind of the part where you don't have to worry about with some of these kind of portfolio ITIN loans.
Yeah, and that's and with the ITIN program, I'll just want to back up to, we do occasionally get those that qualify for Fannie and Freddie, and you could do those with as little as 3% down, but they have to be here with a valid work visa and have some of those other requirements. But we do those. Now, we have a very, we have there's studies out there that talk about the Hispanic population here in the United States is going to be one of the largest buying segments by 2030. One of the largest buying segments in this program certainly addresses a lot of folks who are here with an ITIN, not with the work visa, and certainly not even the Social Security number. So this is a great program. Being able to do it with as little as 10% down is fantastic. We do have some other small community banks in Chicago who do attempt to service this product. And while they have a great product, they also don't really have the capacity to handle things in a timely manner. And, it creates a situation where, I have this great thing, but I can't give it to you. So, versus having your client go through that and asking a seller to wait, a long extended period of time to get that loan done, this is a loan you guys can bring here and we can get done in more manageable timeframes, like 30 days, as opposed to 60 or 90.
And then to kind of piggyback on that, like if you send us a borrower or a buyer that does have an ITIN and not a social, we're gonna exhaust our option to try to take them Fannie Mae and Freddie Mac so that the buyer only has to put 3% down. Just know that if for some reason, where most banks will stop once they go, hey, we can't do it Fannie Mae or Freddie Mac, sorry, can't help you, we have this program in our back pocket.
Yeah. No, that's perfect. So yeah, and any questions from anybody about ITIN or any of these other near miss or fallout programs, let us know. If you've got some things that you'd want to discuss with us personally, definitely give us a call. Our team line, 847-603-2300. Best way to get somebody on our team on the phone. And then there you go. Tony put it in there. So we got, I think this was our last, this our last slide, or do we have one more?
I got one more. So this is basically just a little summary for you guys. And we can send this out to you guys. I send it over to Tony so she can go ahead and send it out. But then the one last thing I wanted to mention is we actually do have marketing material for all of this information, and we have joint marketing material. So talk to your loan officers about that, where if you want to kind of get some of this information out to some of your borrowers to try to get more business for yourselves, we do have joint marketing material. We have ones for the actual individual programs, but then we also kind of have a like a grab bag of everything that we do, sort of thing.
That's good. So let's see. Juliet asks, with low credit score down payment, will it be higher interest rates? So yeah, go ahead, Paul. Would you expect to pay a higher interest rate with one of these programs versus agency?
Yes, you will. You definitely will. So it's not going to be, you're not looking at 10% or anything, but as a general rule of thumb, and this is kind of what I always, when I'm talking to loan officers about this, is generally what I tell people is you want to exhaust Fannie Mae and Freddie Mac, sometimes FHA. It depends on FHA though, because of that mortgage insurance. But you want to exhaust Fannie Mae and Freddie Mac before you start looking into these loan programs. Because at the end of the day, A, we want to help people get into homes, but B, we want to put them into the best possible loan we can put them into. The first place where, like, if you call us with the self-employed borrower, we're not taking them right to a bank statement loan. We're going to look and see if we can take them Fannie Mae, because if we can get them the best interest rate, absolutely can. But we don't want to leave borrowers out in the cold by not looking into these programs as well, if that makes sense.
Yeah, and when I qualify a borrower, a lot of times where we start in that conversation is, what's your payment comfort level? I mean, just because I can use one of these unique products to get you into a home, I'm not the one writing the check every month. And we want to know that that client, when they write that check, they're going to have money to live, and we put them in a situation to succeed. So ultimately, it's super important to us. Now, we do also concentrate on payment because sometimes people get too deep into the woods about interest rate. Oh my gosh, the interest rate's X. Oh my gosh, the interest rate's this. And really there's nothing when you write that check out. Of course, I'm old school, right? Everybody's connecting their bank account to their mortgage lender, but ultimately when you're sending that money in, there's nothing on that that says, oh, by the way, my rate is 6.5. It's just your payment. That's your housing expense. And for a lot of folks here, the alternative is to rent. And guys, the renting situation right now for a potential home buyer who might be discouraged and go back into renting, here's what landlords are looking for: 700 credit score, 720 credit score minimum. I've heard of landlords out there at asking 3 or 4 times net income to the monthly rent. Well, I mean, that's pretty excessive. We just heard a story of one of our buyers. They were offered a renewal. They could renew for $200 more a month, minimum 2-year contract on the lease, or if they only want to stay for a year, it's $500 increase to their monthly rent. I mean, these landlords are in just as strong a seat as the sellers. And so if we can create a mortgage payment, like I said, even if it's at 6.5 or 6.75, we can create a mortgage payment that gets them into a house and gets them some home ownership and gets them off that rental hamster wheel where they're just throwing money out the window. Then this is going to be the better product, really, regardless of interest rate. The payment is what's most important. Being able to accumulate some interest is or accumulate some equity through paying down your mortgage is most important, and not really being subject to the whim of a landlord who may arbitrarily either A, raise your interest or raise your rent payment a lot, or B, maybe it's time for them to sell and now you're you're out on the street looking for something else to do. So with these programs, if you guys want to have marketing materials, reach out to me. We'll get you invited over to Total Expert, which will give us an opportunity to co-brand some of this marketing material for you. And we do have, Paul, did you want to cover anything? Because I want to talk about a couple upcoming events now that we've kind of crossed the you're good?
No, I'm good. Yeah, I'm good.
Okay. All right. So guys, we have 2 really exciting events coming up in June. So our first event is going to be June 7th. It's our next Lunch and Learn. It's coming up a little bit quick just because we had some conflicts in some places of where we could have put this, but I want to tell you guys, this is one you don't want to miss. It's how to use loan products to create appraisal gap offers. So we're going to have somebody on from our renovation division who's going to be talking about how to use FHA loan products to help you guys create appraisal gap offers, when in fact we're going to use the mortgage product to take care of the gap. We're going to do the same thing. We're going to have Tim on, one of our PMI guys on, who's going to show us how to do that with a conventional offer. We're going to have our renovation folks on there. If you guys are in a situation where you have buyers, you need to make an appraisal gap offer, but the buyer doesn't know if they have the money or how to structure it, you want to hit that Lunch and Learn June 7th. After that, we have in the month of June, on June 25th, we are bringing back Ryan Shafkas. He's a real estate tax attorney who handles commercial and residential tax, tax review or tax, I'm at a loss for the word. He basically goes to the counties and says, hey, we don't agree with what you're taxing this homeowner. We're going to go ahead. He's going to fight for you. Why we want to listen to him is he's going to show you how to read your tax bill and how to contest it. That's the word I was looking for. How to read your property tax bill, how to make sure you're getting all the exemptions you should be getting. And then if you don't agree with it, how to contest it with your township. Why we do that in June is because most of the townships in Illinois start opening up in July, August, and September. Ryan has been a great asset for us. We're really excited about that. That's going to be Saturday, June 25th from 9 to 10. Invite your clients. We have appeal. Thank you. Tony sent that to me. So he will help you appeal your taxes. So sorry about that, guys. And then hopefully we'll have my camera worked out so we don't have this stuck image here. But thankfully we had Paul on here helping us out. If you guys have no other questions, thank you all for your attendance, and keep an eye out for a video on Friday. Have a great Memorial Day weekend. God bless you. And Paul, thank you very much for all your help, buddy.
Thanks, guys.
All right, guys, have a great one. Bye-bye.
Yeah, have a good one.